All right, welcome. We are here. We are live. We made it. Thanks for bearing with me there. I need to work on the transition from Trader TV, but so glad that you guys could come over and join us. We got some really good stuff here today. We're going to be talking about smart money concepts, or maybe you've heard of the ICT system. I think there's a lot of really good stuff there. That's where I learned a lot of what I trade off of. I've experimented with many systems, but I always come back to some of these basic concepts. So I'm here to share them with you, and we can go over live charts too if we have times. We have a lot of good stuff to talk about. Sorry, I'm getting distracted by chat already. Hey guys, welcome. Thanks so much for the love. This will be fun. So let me see. I'm going to add my screen to stage to screen to stage. There it is. Okay, words are hard, but these concepts are easy. We're going to get it. So let me hop into presenting mode and we will get going. There we go. Now we're cooking. All right. Welcome, Tyler. Welcome, Maxwell. Welcome, DJ 2AM. And we got some guys in the Discord channel as well. Thank you guys for all being here. All right. I see you. Let's go. So smart money concepts. How do we trade like the banks? We as retail, we have a tendency to think like retail, whether we want to admit it or not. It's easy to chase breakouts. It's easy to think the world's falling and sell the whole. So what do we want to do? We want to figure out how to get on the other side of that equation and start thinking like the smart money that is using us as exit liquidity. Because I don't know about you, but I don't like being exit liquidity. It feels bad. So these kind of basic principles have really helped me with that. And it's a big process, right? You get the basics, then you add another tool to your tool belt and you keep building it out. But I want to give you a few really good tools that you can use, and you'll see them actionable every single day. It's really, really good stuff that's very widely applicable. So that's what we're going to be going over today. Say that once more.
I think we lost audio from you on Discord.
In Discord, did we lose audio? Let me try to figure that out. Says I'm talking. Let me know if you need anything from me, but I'm gonna power through here. Okay, all right. Smart money concepts. Let's get into it. What are we going to be talking about?
Now it's good, yeah.
Okay, audio good? Great, glad to hear. Introduction. Basically what I just did. We'll talk a little bit more about the basics here, and it'll be good stuff. Oh, Exotic Seal, I see you in the chat, brother. Glad you could make it. We are going to go over the core principles here of basically market manipulation 101. It's not a conspiracy. It's not the hedgies are out to get us. It's just the mechanics behind a market move, and we're going to talk about that. We're going to talk over some key terms. We're going to go over the concept of kill zones. We are going to get into some specific kind of strategies or pieces of the strategy here. So we got liquidity grabs, we got order blocks, and we got fair value gaps. There's a lot more, but I wanted to start with these because they're super building blocks of this whole stuff. So we're going to get into some of those. I'll give you some examples. We are going to actually talk about actually trading the system. So we're going to identify those kill zones, which are high probability actionable times to trade the market. We're going to talk about marking down liquidity on your charts to kind of frame each trade, so you have some idea of where we're going and in the market, to inform your bias. We're going to talk about displacement, which is the act of basically a large move that breaks a range. And so we're going to talk about how to identify that and how to play that. And we'll go over talking about using order blocks as entries once you know what those concepts are. So we're going to go over some common mistakes that people make, and then I'm going to take some questions because last time you guys had really great questions, and I love interacting with y'all. I love meeting you where you're at and figuring out how I can best help you become a better trader. So that's what we're going to be doing today. Let's get right into it here. So what is ICT, SMC, DYOR, WAGMI, all these all these acronyms, right? It gets overwhelming. So let's keep it simple. ICT, that's inner circle trader. He's a guy. He's not a god. Exotic Seal in the chat knows. I used to follow this guy a lot closer. His tradings may be hit or miss, but his concepts are really good because I'll be honest, they're not really his concepts. They're very well-established market mechanics that he put fancy names on. And I like the name, so I'm gonna use them for that little bit of presentation value. But you can call order blocks supply and demand zones. You can call all of these things have names. Fair value gaps. That's just a gap basically. It's just a spot in the chart with low volume that's easy to move through. So stuff like that. You could say displacement. You could say, damn, that's a big candle. There's other names for all of these, but the concepts are really rock solid. So that's what we're going to be working with here. Smart money concepts, or SMC, is just kind of like the larger umbrella of these things. And it's basically what I talked about before. It's getting in the mind of the other side of the trade, the institutional trades. So let's see. What do we learn here? We'll learn these liquidity grabs, how basically the market, those evil market makers. No, it's not like that, but how the market tends to come down and raid stops and just get really good entries in any given range. So we'll talk about that, and order blocks, which are basically you can take a section of the chart, a cohort of traders, and you can kind of personify them as, oh, that's a big buyer if it does this. That's a big seller if it does this. So we'll talk about how to identify those and basically what we can do to actionably trade off of those. And then fair value gaps, probably the most popular of the ICT lingo. And they're great. Everybody can kind of start to recognize them. It's a 3-bar pattern with a big gap in the middle. We'll talk about it. We'll look at them. We will learn how to trade them. It'll be good stuff. But I just wanted to start with a little overview and a quote from the GOAT. The stock market is a device for transferring money from the impatient to the patient. Y'all know who said that, right? My man Warren Buffett, the OG. So this guy knows his fair value gaps. Let me tell you, he's sitting there with his quants trading ICT systems all day long. I'm telling you. No, he probably doesn't know who ICT is, but he definitely knows about all of these principles. And the important thing is that when you are patient, you don't need to chase those big breakout candles. You don't need to get slammed if it doesn't work. You can frame your trade. You can watch the displacement or those big candles happen and say, hey, that's awesome. Now I have more information for the setup I know I'm going to take. My setup is high probability. Chasing those big candles, not high probability, right? I know we've all been there. You see the big candle, you get tunnel vision, and you just send it. And then the market comes and raids a stop. You're probably size too big. You get stopped out. It's a whole thing. Hey, Stuart, welcome. Glad you can make it. So we are going over ICT, or smart money principles. We are just getting into it, so you came at the right time here. So let's jump into some core principles here. We got our smart money playbook, so to speak. So let's talk about market manipulation. It's basically just, okay, so you have an established range. You have a swing high, a swing low. There's going to be a lot of efficient navigation of that range by market makers and by big money contingencies like banks, hedge funds, that kind of thing. So we have a lot of moving parts in this complex system, right? And if we get the kind of hand tip, the signal that we're moving in a certain direction, it doesn't mean we're going to move straight there, right? So when we mark liquidity, which we'll talk about in a little bit, we are basically saying, okay, here's a big pocket of buyers or sellers that we think it's going to dip into and then rip. So that would be kind of falling under this market manipulation, where basically they hunt big stop orders. They're not hunting you and me, but if there's a large order on the tape, then the market makers have an incentive to drive price to that place and make more transactions. So that's why you'll see a lot of action around high liquidity nodes, maybe on your volume profile or something like that, TPO, if anybody uses that. So those are areas where we can talk about more in depth in a little bit. But essentially, we are looking for these liquidity grabs where they're coming down or up, and they are basically sweeping stops, getting a certain cohort, a certain percentage of the market out there, and then they are basically buying their fear or their stops. So retail buys highs and sells lows. Institutions do the opposite. Basically, they are better at this than us. They have a lot more tools than us. But here's the thing: they have to move in such large size that they telegraph their moves, and it's hard for them to get in and out. And so we, as a retail trader, people don't talk about this. We actually have a very big advantage. We just have to learn how to use it and not give into our retail mind where we're just chasing the next candle. We can't just skate towards the puck, right? We got to skate towards where the puck is going. So that's what I'm hoping to help teach you guys how to do. Thomas, yes, this will be recorded and available later, although I appreciate you here live. This way you get to ask questions and stuff. So yeah, absolutely. You can always find all the recorded webinars on Trade the Pool on the live tab on our YouTube channel. And you'll see my pretty face in the screenshots for anything I'm on. yeah, it's good stuff. We'll have a lot of fun. I plan on doing this as long as they'll have me. So there's going to be a lot of good content that we're building out. Also, a little side note before we get into it more. If anybody has any suggestions for topics, I want to hear from you guys and teach you guys what you want to know. So feel free to drop those, and I will be keeping tabs there. So let's talk over some key terms here. We have liquidity pools, and that is just an area where stops cluster. So maybe you have a swing low, goes up a little bit, it comes down, and it catches right around the same area. And then you come back and you're in the middle of the range. So there's two sets of stops below those two swing lows. So that's an area where stops are clustered. And let's talk really quickly about why there are two sets of stops there. So each time the market kind of went down and then started to move up again, any new traders, any new longs there, they're going to say, okay, well, I'm long unless we lose this swing low, right? Unless we make a new low, and then, okay, my idea is wrong, I have to reevaluate. So that's just basic risk management. Most people or most institutions will do something like that, right? So basically we're looking for areas where you would expect stops to get ran. So if you're bullish, you see relative equal lows, you wanna play for a range break upside, but it's a little overextended. Maybe it's near the 0.68 fib on the range. We can talk more about that stuff too later. But it's often prudent to wait for a liquidity grab and wait for a return to that liquidity pool and kind of to confirm the idea. So that's something to consider. It's really important. And then I want to talk about the kill zone concept. So not as scary as it sounds. It's actually the opposite, because it'll keep you safe. And what a kill zone is there are certain times where the market has really high liquidity. And by that, I mean there's a lot of transactions happening, a lot of trading going on. And that will give us the follow through that we're expecting on the move, the clarity of the move. It's less of that, midday afternoon, lunchtime, choppy, washy, up and down. It's kind of that kind of stuff where if you have a lot of volume, you'll get follow through, and that's usually when the targets are hit. And then it's just kind of, as I would call it, garbage time in the other times. And the thing about trading is, I mean, there's 24-hour markets now. You could do it in and out all day long and burn out really quick. So I'm really focused on trading the best times of the market, and ideally the best stocks in the market. But all of these concepts apply to all stocks. So that's the best thing here. So we're talking about London, 2 to 5 a.m. EST. That's got a lot of liquidity. That's when the London markets are open, and they're doing their thing overseas. And then, what I usually trade is the New York session, and that's 8 to 11 a.m. So, these are times where you get really good follow through on your moves. That's the key thing there. And, if you crunch the numbers, if you look at your own trades, I bet you'll find you trade statistically better in these windows than just trading at lunch or trading end of the day. Although end of the day is not bad. I trade some at the end of the day too. It's kind of like a half kill zone there. But in general, we're looking for the high liquidity times so that our trades work as anticipated on a higher percentage basis. So someone figured out how to add GIFs to their GIFs to their presentation here. So I guess I'm showing off a tiny bit. I'm like a grandma with a laptop sending off emails to all the grandkids. It's impressive to me. Anyways, let's talk about some key strategies here, particularly liquidity grabs. So liquidity grabs, we are basically looking for a wick into support or resistance and then rapid reversal. So how many times have you seen this where you're like, okay, I'm watching a range and we get a break above, and sorry, I just was told that I'm not full screen on Discord. I am not sure how to fix that, to be completely honest. One sec there. So you're seeing my bar there. Let me see. I can at least remove the bookmarks bar, give you a little more space. Sorry, I'm not 100% sure how to clear that out. Tim, let me know if you need anything else from me there. Let's see. What were we going over? Oh yes, wicking into support or resistance. So how many times have you been trading a range and you see a big candle and you're like, oh my goodness, this is it. It's happening. And then it just reverses super quickly. So that's giving you a lot of information. That was a liquidity raid or a stop raid, right? So we're going to be looking for those, and then we'll learn how to integrate that into our system. All right, give me one sec here. I am searching for a full screen button for the Discord, boys. That's not it. All right, I'm struggling. I'm sorry, Tim. I will try to do this in between, but I don't want to get too hung up. If you guys in Discord, you can see my stream at least most of the window, right? All right. Sorry for the hiccups here. I'm like I said, I'm a grandma with a laptop. So we will continue to hone in week after week. I promise, guys. I promise. Just stick with me. I got good stuff to say. So in terms of how to trade these, so we get the sweep, like I said, sweeping over a range, and then we're going to target a fair value gap. So let's talk about those. Oh, just kidding. My order's wrong. We're going to talk about order blocks first. Hold that thought. So order blocks. An order block is when a candle comes down and then comes up and reclaims. Let's see. Okay, Nygaard, we're dual streaming onto our Discord server. It's Trade the Pool on Discord. I think someone can drop a link for you, and if not, I'll drop it after this webinar. Thanks for asking. It's a really good community, great people. So order blocks here. Order blocks are the concept. Thank you, Tim. Appreciate that. Order blocks are a concept of basically price coming down, coming up, and reclaiming a zone. So on this chart right here, we have this red candle. Then it reclaims and it forms a zone of support. And, price will come up. And then if it comes back down, we're looking in this zone to see if that buyer is still there. So I basically, it is this is a place where everybody got a little bit scared, but big money was actually sitting down here and had a big order on the tape. So think about it like this. You're trading at, let's call this 540, something like that. And this is like 535 or something. So market's trading up here, but all the market makers, they see on their books, oh man, there's a massive buy order right down here, $5. And so, they're always buying and selling, but they can modulate the pressure they're putting on the market, right? So they can basically cause the market to fall down, and all of a sudden they're getting a ton of transactions at this 535 handle, and the market immediately responds to the upside, right? So what's this created right here? What is this cohort of traders telling us? It was retail selling, and it was smart money buying and trapping that retail and basically kind of causing a little squeeze out of that zone. So the idea here is when we come back into the order blocks, we would expect these long-term buyers to still be there as long as the trend that caused them to buy in the first place is intact, right? So they're buying down here. I'm sure they're selling somewhere on the way up. And when it comes back down, I want to see them reloading. I want to see them continuing this trend. So that's what an order block is. And it works just the same on the other side of the tape too. So a candle that went up and then came back and reversed. And you can use this on all time frames. That's another thing. This is a daily chart. This is SPY, I think last August or something, but this works on the 1 minute candles too. Obviously, you got to give more credence to the higher time frame ones. They hold more weight. They're more important because they are representing a larger cohort of traders, right? So all the intraday price action on the way down and all the intraday price action on the way up and through the top of these daily candles over the course of 3 days, all of that, if you personify that whole block of traders, you can say essentially it was a big buy order. It's it's a little more granular than that, but that's how you can conceptualize it for this. So yeah, look to identify those tight candle clusters on higher time frames, like 1 hour plus, and then you can trade the retest. So if we're watching this order block and it comes down like this, you're buying it open here, and you're just letting it rip. Hey, Spencer, good to see you, man. Good to see you, buddy. Thanks for joining. We are going over ICT strategies here. We just talked about order blocks, and now we're going to jump into fair value gaps, everybody's favorite. This is the crowd pleaser, right? Everybody loves a good fair value gap. So what is a fair value gap? It is a 3-bar pattern. We have the first bar here, the second bar here, and the third bar here. We take the bottom of the first bar, this first line. We take the top of the third bar. If there is a gap in between those two levels, bottom of the first and top of the third, then this is a fair value gap. So you know what it is. What is it really, though? What does it do? Why do we care? So fair value gaps are basically a bubble in the tape. And let me explain what I mean there. I'm taking this literally. It's like a little air bubble. It's like an air pocket. So if any of you guys have painted a house and with one of those big rollers, takes forever, you want to get it done fast, you start winging that thing, you start really going fast. And what happens? You get air bubbles, right? So the market is the paint roller. It's going up, it's going down, it's going up. It's navigating a range or the wall of the house in a way that basically is the most efficient possible. So the most efficient way is to basically retransact areas where there isn't a lot of trades. So if you're a market maker and you get one of these gaps where it's just straight directional down for a day, then there were a lot of orders that just kind of got blazed right through. And if they brought it back up here, they'd be able to transact more orders. Maybe people are like, oh, snap, this was kind of really straight move. When we get this retest, I'm bailing on my longs. And maybe they have to wait a couple weeks, but you'll see that kind of price memory where when you go back into this zone, it will show you something. Oftentimes it will wick back up into it and then reject again. But these are really good targets because, like I said with the painting analogy, if you go too fast, there's an air bubble and you're going to need to come back for it. You're going to need to clean it up, right? So this is the market maker's version of cleaning up the tape. So that's why we talked about the order blocks and the fair value gaps. The order blocks are what we enter off of, and the fair value gaps are our targets. We can talk about other targets too, but in general, this is like the high probability meat and potatoes. This is the kind of strategy where you can get comfortable with it, of course, first, but then you can take relatively large positions with relatively tight stops. And for a good 6 months, I was using the system, and I was just taking one trade a day, like a couple micro contracts on the futures, and I would just look for 5 to 10 points, and I would just consistently get those 5 to 10 points. Hey, 10, welcome. So we're talking fair value gaps here. And how you can trade them is price often retraces 70% of the given range to fill fair value gaps before continuing. So we have this big move down here. We can call it displacement. So displacement is say this was the bottom of the range here, this little range, and then we push through it. So we displaced that range. It's displacement through, and it left an air bubble here. So now we're going to zoom in, fast forward a little. We come down. And now we have a trading range here. Here's the top of the range. Here's the bottom of the range. So price very often will retrace 70% of this range. And I'm just eyeballing it, but I guarantee you this is right about 70% right in here. So if you're biased short and you see this displacement happen, but you don't want to chase, get chopped out, you can put an alert right up here and you can wait for price to come to you, and you can pinpoint that short. And I swear I didn't go searching for this picture. I was like, all right, SPY, scroll to the left a little bit. Let's find a fair value gap. There's a fair value gap. We'll look over to the right. Well, there's the 70% displacement. So it's really, really cool. You guys either take notes or come back and watch this video, pump my views. But I really recommend you start to kind of acquire like a mental checklist, because then as you go over charts, this stuff will jump out at you. Kind of ping me during the week, like, Steve, I found the thing. It did the thing, because the amount of times it'll jump out at you is wild. I'm telling you, it's really, really cool stuff. It's kind of like opening the door to a whole new world. So those are fair value gaps for you. Now let's talk about trading the system a little bit. We kind of Sorry, distracted by chat. We kind of talked about this a little bit, but let's get into a little bit more detail. The session timing is the kill zones that we discussed. So the idea here is that we are just eliminating things that can trip us up. So one thing that can trip us up is trading in a wrong time where there's low liquidity and the move just doesn't really happen. So yeah, we got that going on. We want to trade in the best times, 2 to 5 a.m. London time if you're a night owl, or a really early bird, I suppose. And then New York kill session is great, and that is 8 to 9, or I'm sorry, 8 to, let's call it 11. You know, there's a couple of good hours of moves in there where you can be focusing in, and then you can take your trades and you can go about your day, and you don't have to worry about you're going to miss everything, right? Because you know you'll be right back in front of the screen for the next high probability trade time. So this is a huge thing for me because it's about conserving mental capital. Everybody talks about conserving your actual capital, you know, stop losses, risk management, but the mental capital gets burned so fast. We can only make a finite amount of decisions every day, and the more we have to make, and the more stressful each one is, the worse the next ones will be. So this is just the way brains work, right? You know, so it's super important to keep your brain sharp for when it needs to be there, right? So that's how you avoid over trading. That's how you avoid giving back your morning wins. If you just walk away from the screen after the morning win, you're golden, right? So session timing, super key. We will find liquidity pools. We're going to mark those recent swings high and low. And Spencer, yeah, if we have time, I'll definitely we can definitely mark up some charts on stream here. So if you guys want that, we can talk about that too. But yeah, basically this is stuff you can do any day. You can pop open your charts. You can do it at the right time. We talked about that. You can find the liquidity pools. We'll talk about that. Basically marking swing highs and swing lows, those order blocks we talked about. Those are our liquidity pools. Then we wait for displacement, a strong move through some key, either range or, you know, anything we're kind of watching. Maybe it's the opening range, maybe it's pre-market highs. I took what was it, yesterday? Yeah, I took a displacement through opening highs. I waited for it to come back, and then it was just off to the races, if I recall. Oh man, when was that? Time flies, I swear. But anyways, it was sometime this week. We can then enter it, the order block, what we talked about in the first section there. And you can also, you know how we said the fair value gaps are usually the target. Well, they're the target if you're entering off the order block. You can also enter on those fair value gaps if you're anticipating a reversal there. So there's a little bit of give and take here. You know, there's a little bit of it's like I always say, it's an art, not a science, right? Certain aspects of it are very scientific and mathematical. You can quantify them with algorithms that are trading on a high frequency. But a lot of times you gotta have the art, right? You gotta have the ability, the mental flexibility to entertain contingencies that maybe aren't exactly what you see at first. Because remember, this stuff works on all time frames. So there will be like different setups that are nestled within higher time frame ones. And maybe you're focused too much on the smaller one and you miss the bigger picture. You miss the forest for the trees, so to speak. So it's really interesting. And the more time you spend with these systems in your head, looking at charts, the more they'll just jump out at you. And then after a while, you won't even need to mark up your fair value gaps or your order blocks, because you'll just know them the second you look at a chart. So after we do all that, we get our entry, then we're targeting the next liquidity zone. And yeah, it's pretty pragmatic, right? You know, there's a lot of ways that you can go wrong just out there on your own trading, but I really like systems that give you a really strong framework, and they just really let you kind of you know, they give you a better rubric, a better kind of scaffolding in which you can paint your beautiful art on the canvas, right? So, you know, it's good stuff. It really does work. These are very like reliable systems that, I mean, they don't work every time. You know, there's always just, you know, there could be a wild Trump tweet, there could be a wild market moving event, there could just be you know, lower liquidity market in general and more frothiness, and just the stops swing wider, and you can't manage your risk like you normally do. All of these things happen, but they'll happen a lot less with this stuff. Oh, we got some thank yous. We got some learnings. That's what I love to hear. I swear, guys, like trading, I don't want to underplay the amount of work that it goes into being a good trader, but it's not that hard to understand these concepts that I'm teaching. The hard part is battling your own discipline and always being hungry to learn. And so whenever people are saying, I'm learning, I'm listening, these are the people that I come back a few months later and they're trading me under the table, right? Because there's always more to learn. And as long as you're hungry for it and you don't burn out, you have great things ahead. You'll always hear like 99% of traders end up failing. 99% of people don't stick with something that sucks at first. I really think that's the gist of it. It's not that this is like some elite thing that only the best of the best can do. Only the stubborn or the crazy can do it, I think, because you gotta be able to take some shots and keep on moving forward. So there's some ways you can kind of mitigate the financial tuition or damage you might accrue otherwise. Our trade paper accounts, I think that's a super underutilized tool that's very, very valuable. You don't always have to trade your own money. Stuart, discipline is your biggest challenge? Absolutely, man. Absolutely. Mine too. And I've been doing this for years. And still every day you wake up, look yourself in the mirror and say, hey, I'm not going to be exit liquidity today. I'm not going to do any dumb stuff today. And, some days you can, some days it doesn't work out, but we're always striving for better tomorrow, right? So I think that I know this seems a little tangential to what we're talking about, but I think mindset is so crucial. So no matter what I'm talking about, I'll always bring it back around to mindset. So we got our basic rubric for the system here. And, if you look up other stuff on ICT, there's a lot of different kind of subsystems. Like I trade his silver bullet setup a lot, which is quite similar to this, but there's a few more parameters. There's a lot of different ways you can trade these ideas. So I encourage you to look into them on your own. And if there's interest, I'll do some more lessons on here too. And it's really good stuff. I swear I wouldn't steer you wrong. If you listen to him on Twitter, ICT Michael Huddleston or whatever his name is, he's got quite an ego. I'll leave it at that. I wouldn't say follow his trades. I'd say learn from his ideas because his ideas are just time old, concepts that are really good stuff. So really quickly, some common mistakes are trading in the non-kill zone hours, like we talked about. You're going to get chopped out a lot more often. The moves won't stick there as often. Maybe you're right on directionality and you get a good entry, but there's no follow through yet. And they're waiting to do that in the next session, maybe Asian session, maybe London session. And there's no incentive to get the move you want when you want it. So we're trying to pair that, right? We're trying to, it's kind of like trading options where there's an extra dimension of needing to get the time right. So we're trying to just eliminate the extra dimension of the time because we know that if there's a move, it'll very likely happen in this time. So another is ignoring higher time frame order blocks. So I was kind of talking about that earlier with like the nested patterns, like maybe there's a bearish setup nestled in a bigger bullish setup on a higher time frame. So ignoring that higher time frame order block, if you're just looking at a 1 minute chart, then you've got support here, it's out here. The price comes down and you're just thinking we're in free fall. Where are we going to stop? We broke yesterday's low. We broke the weekly low, X, Y, and Z. We broke the 237-day banana moving average, whatever, there's so many indicators. But if you're not looking at the larger picture, you won't see that fat bank of support just waiting there, licking its chops like, yeah, come to me. And then that's how you can get those big, intense capitulation bottoms into sharp rallies where it's like, oh man, when you get caught on the wrong side of that, it's terrible. So this is really, really useful stuff. And I think it's really important to always, no matter what system you're trading, zoom out. Either have a daily chart up in the corner of your screen, the very least an hourly. But honestly, you need some price memory in front of you, at the very least be flipping through it throughout the day because you got to have reference points. I'll say it again. And the last thing is just overcomplicating things, with too many concepts, you add too many tools to your tool belt, you don't know which to pull out and you get options paralysis or, analysis paralysis and all that stuff. So that's why I started with 3 here. They're very widely used. They're very easy to apply to whatever trading system you use and just get comfortable with them. Just roll them around in your mind while you're looking at charts and start to identify them. And then when you feel comfortable, then come back to me and I'll teach you some more stuff because there's a lot of good concepts here. But in general, don't overwhelm yourself. If you feel overwhelmed, take a step back, and it's just, it's all about incremental progress. That's the name of the game here. So let's see, I think we're ready for some questions and answers here. So I'm going to start going through the starred messages and then we'll go from there. So Get some water here. Alrighty. My man Stuart, thanks for coming back. Steve, is there a particular trading time of the US market that you tend to avoid? Absolutely. Yeah. So we have the first couple hours of market. We'll call it 3 hours, from half an hour before market opens to 2.5 hours after. And it's just really reliable. You get the clean moves, you get the nice displacement, or the half hour flips. Often like a half an hour in, you'll see the trend kind of change and you get a nice entry. So there's a lot of reasons I like trading it. And then I'll trade the end of the day too. If it looks good, I'll trade that last, like, we'll call it 2 hours, maybe an hour and a half. The last 2 hours of the trading day, volume comes back in, but in the middle, those couple hours in the middle there, it's kind of garbage. So I'm not a fan of trading that. I call it garbage time because the trades don't stick nearly as well. Oftentimes you'll have a winner in the morning that'll just roll over on you a little bit, and then the volume will pick back up and it'll keep doing its thing after lunch and then into close. So I would say avoid the middle of the day, over lunch there. And then if you're trading other times, like if you're a futures trader or a crypto trader, stick to the kill zones. You have the Asian kill zone, you have the London kill zone, and you have the New York kill zone. And you can look those up. I'm West Coast, so for me, Asian kill zone starts at 6 o'clock, so 9 o'clock for market time. London will be 2 to 5 a.m. market time, and then 8 to 11ish market time for the New York kill zone. So yeah, good stuff there. All good stuff. We got my man Spencer. You're a big FVG guy. You're a big guy in general. This guy came and visited me this weekend. We had a good time. Yeah, we're big FVG guys in here. We like it. They're very reliable. All right, we got Callie, and she says, when you say target, do you mean profit target or where you should enter? Great question. I should have been more clear. So in general, when I'm saying target, that's where I'm looking for price to go. So usually we'll be getting in at like an order block, or maybe a 70% pullback into a fair value gap. And then we will be targeting the liquidity that we marked out. And you know what? I can pull up a chart and we can talk about that. Let me switch tabs. All right. So we'll keep it simple. This is my daily SPY chart. Feel free to take a screenshot. I got some really good responsive levels up here. So this was the order block we were looking at in the example. So price came down and then it reclaimed. So this is a valid support. As you can see, we came down and tested it and we ripped off of this. And then all the way down here, we actually swept it. So in general, when you're marking a chart, you're looking to mark where you think the stops are on each side, right? So for me, when I zoom in here, like say we're coming down, I'm looking at this low and this low, especially this area here. And it was a pretty crazy move, right? This is a weekly candle. So it was a pretty crazy move here where we just had capitulation and we actually sliced through this before kind of reclaiming it. So again, these aren't always precise. It's more about general ideas of like where will the liquidity be? Where will the buyers be? So when you're in free fall down here, you're thinking, okay, where could buyers be? Let's scroll back. Maybe there's some buyers under here, but mostly I see there's buyers down in here and there's really good buying here. So those are the areas where we're kind of watching for a response. And as you can see, this was a very violent move and it just slammed down. But this was our liquidity to basically look to get long in. So let's zoom in a little bit to an hourly chart. And we got a good example right here where price came down. And we can look at like right around here where it came down and reclaimed, came down, swept out these stops, swept out this liquidity on the daily there. And then when it came up, it closed over there and essentially made this an order block. So I'm going to take this off my screen and we're going to redraw it. We're going to do it live here. So that block right there is support. And Actually, we never even traded back into it. So I think a better example would be actually we can do this area over here. We came down, chopped around, pushed up. So, right around where kind of the neckline of this kind of move is, basically the consolidation. So we were talking about on the hourly chart seeing kind of tight consolidation there. It came back and then reclaimed and instantly pushed off and got a really nice move off of it, right? So that is like establishing where the liquidity is looking back a day. So say we're coming into this trading session, or say we're up here, right? Another thing we can do is, well, we had this surge candle here. So I'm going to mark that, go up a little bit. And this is an area where I would expect selling to occur. So see how we kind of frame the range based on this one move? And then overnight, you see it comes up and it sweeps that really cleanly, and then a sell starts. So what are we targeting for a sell? Basically, for here, we decided, okay, I think we're bullish. We got a bullish move, and it was after the end of the capitulation move. I'm looking for a move up. Where do I enter if I miss this? Or, because if you just get in end of the day here, you're feeling great here, and then holy moly, hope you sold. So where we want to enter is back into the same supply or same demand zone, right? The same order block, because this is where buyers finally stepped in after just tons of blood. So if this is the bottom, if we're right in our bias that we are going to move up, then we want to see this zone retested and hold. So comes down, and as you can see, this is where we start seeing big buy candles coming in. Big buy candles coming in and sure, there is some red. It does take some chopping and negotiation, but you can think about it like this. As long as this zone holds, and you can even draw it down to the bottom of that wick, that's what I do. As long as this zone holds, you're good. And then you would be looking for expansion past this range, and you'd be trading in this whole range here, right? So if it holds, there's a lot of room to the upside. And if you're wrong, you stop out under this candle. So this is why it's really helpful to frame these ideas using these concepts, because it can give you really, really good risk to reward. So let's see what the RR is here. Say you get in when it reclaims this block, and you're looking for, let's just say you're looking for that sweep high, and you stop out under there. So 2.35 risk reward here. You have the chance to make over 2 to 1, just for this little range that we're trading here. So yeah, these are really great setups, and they'll just come up over and over again. We can just go to a random spot and we'll find something to talk about. I will do this random spot as needed for the as I go through the questions here, because I gotta keep moving. I'm seeing a lot and I love it. Thank you for asking questions, guys. Is there an indicator for that? There is. It is on TradingView called Lux Algo. Yeah, Lux Algo Smart Money Concepts. That'll mark order blocks and fair value gaps for you. And yeah, it's good stuff. I don't actually use it anymore just because, they just jump out at me at this point. But, if you're learning, it's great because you can just go through a bunch of charts and see, oh, yep, there it is, there it is, there it is. Then for a while, flip it off and find them for yourself. So great question. Was that an Aladdin reference back then? Yes, it was an Aladdin reference. I appreciate you, DJ 2AM. It was a whole new world reference, because that is a banger. And I do not care if you disagree, because that is just the truth, just the truth. Spencer, my man, do you look at charts on this stream? What are we doing right now? All right, next question. Carvana looking weird. Spencer, we'll talk about this later. I don't want to get too sidetracked yet. Is my focus NQ or any pair? Yeah, I like to trade NQ a lot. It's just very reliable for me. It's a little bit scary. So whenever there's enough volatility, I'll move to ES. I do a lot of future scalping, but when I trade the market, or trade like my Roth, for example, I will be taking these same setups, but I'll be using TQQQ, SQQQ, maybe SOXS or SOXL. I like the 3X inverse or 3X ETFs. So basically, still just for day trades, right? Because I'm not holding these overnight unless I'm really confident. But those are the instruments I like to use. You can do these things with options, but just remember, you're adding in one more dimension, a time factor, a decay factor, a theta factor that can really mess you up. And if you don't get the move exactly when you expect. So it's kind of like trading on hard mode, and sure, you get rewarded for it, but I'm more of a fan of, I mean, I use my trade the pool account constantly. You know, that's what I really like to trade on. It's you know, managed risk. I can take trades that I believe in, but if I'm wrong, you know, I'm not out my own money. It's a good situation there. So I like that. I like trading futures. Lots of good options there. All right, Tyler, being too greedy chasing the next green candle instead of just taking profit is one of my biggest issues. How can you tell when the moment in the moment, or sorry, when the moment or trend is starting to flip or reverse on the day? It's a great question. It's a great question. So let's see. We can talk about a few things. Just going back to the range on the hourly chart here. There are a couple things you can do. So essentially, it's important to have a bias. You know, it's important to basically know where you think the chart is going to go. So if you're aware that there's like some really juicy stops for them to sweep, or a really juicy fair value gap for them to sweep up into, then you can't expect the range to break right there. So for example, we talked about this trade. Say you traded the order block, you got long here and just straight ripper, right? Straight ripper. There's a few things you can do to kind of gauge when should I get out and what the move is going to do next. So the first is, let's draw a Fibonacci ratio on this, or a Fibonacci retracement, and there we go. Nope, had it right the first time. There we go. Okay. So remember I said very often a trend will reverse 70% of the range before continuing on its direction. So what we saw here is, here's the range. We rip right to the 0.7, right? 70%. And that's called the golden pocket, the golden ratio between the 0.78 fib and the 0.62 fib. And so this is where smart money goes for reversals. We closed high a day here. This was on the tariff rollback announcement. Jubilee, everybody's exuberant. You know, the market is saved, and instant gap down in futures, instant everything, because sellers said, hey, we're in a range. It's going to take a while to digest the range. We are now trading at a premium or over the 50% mark. If you think about trading things, you know, you want to buy at a discount when it's under 50%, you want to sell when it's over 50%. And these fibs help you kind of gauge where to get out, right? So I know I'm getting a little off track here, Tyler, but I'm going to circle it back around here for you. So because of this, say we come back to equilibrium and we're just hanging out in the middle of the range. So what do we think is going to happen here? We think that probably it's going to try to break higher eventually, but first we need to negotiate this area here. So it opened up a gap, a fair value gap, if you will. So you could take a little scalp. I actually did take the scalp or swing overnight, where I said, okay, we are consolidating at the midpoint of the range, midpoint of this range. And we have a target up here. There's the fair value gap target. So for me, there's not really a juicy target to the downside because we just had a nice double bottom. Sure, eventually it'd be nice to go for these stops, but look at the power off of that move. And after such a big move down, I think we're due for some upside here. So that kind of informs my bias, right? Going into this day, I'm saying, okay, I'm looking for a move up. I know what I want. I want this to get tested. And then I'm going to get out and I'm going to see what the price action does, because this is the magnet. And then once the magnet is fulfilled, the magnet gets taken off. So price could go up, price could go down. What we do know is that there's a high probability that it gets there in the first place. So I would say, like, for example, on this big green candle, I was very confident, right? So I was adding into this green candle because I said, okay, we're getting confirmation of the move and I know where it's going. And then up here, I was one of these people selling these wicks up here because I didn't know where we were going. And I thought I was wrong here. I thought maybe it would just surge higher, but you know what? It ended up playing out basically how you would expect, right? They swept it down. They picked up their liquidity. They swept it up and they sold at this 0.7 area. And they just basically said, all right, we got a great price here. We're going to take some off here. We're going to take a lot off here probably. And then if there are still buyers in the middle part of the range, if people still are willing to pay a premium for this product, right? They're not waiting for it to go on sale. They're going, we're going up. If it's going up, then they'll start driving the price up from the equilibrium there. So as we pushed off of equilibrium, I was a buyer. And then I took my money right into this gap, right about the 0.7 area again. So these are the kind of high probability setups that you can just see over and over again. And so I would say, to kind of give you a more succinct answer, it's all about context of where the big candle is taking place. If it's a big candle and it is sweeping a major other level, then you got to be careful and wait for the confirmation of that, because otherwise you can get kind of smashed. Sorry, I'm looking for a good example. Hey, how about all-time highs here? So you have all-time highs here, and it's just kind of grinding up against these previous all-time highs. So then you're up here, and then there's a big red candle, and that's kind of spooky, right? But this was still back when everybody was just mega full bullish. So then this candle, it is a big green candle, but what is it really doing? It's clearing out these stops, these short stops. Anybody who got short on here and says, okay, if it goes back above here, I'm out. Anybody who got short up in here and says, if it goes back above here, I'm out. Anybody who got, well, I guess they already got cleaned out. But anyways, you're clearing out these stops, and then you need to see follow through. And so for me personally, this was, I didn't catch this trade perfectly by any means. I didn't call the top, but in retrospect, it's pretty clean, right? I mean, they swept all of that, and then instantly, almost instantly, there was a bunch of selling pressure, and then the next day it just started heavily showing its hand, right? So here's one more concept that I'll talk about on this chart before moving on to the next question. So we had this little range, it swept and then reversed. So that would be the liquidity raid, right? And then we are looking for displacement. So displacement is a break of this range. So we get the displacement, big red candle. So here's the thing. Here's how we can not chase that big red candle, even if our bias is short. What we can do is we can mark out the range. And look at this. I swear I didn't plan this, but look how accurate this is. We mark out the range. We see displacement through the range. Now we are waiting for there's a couple things to watch here. We're looking for a 70% retrace back into this displacement range, and we get it almost. So I would say the golden pocket is what I look for. So between the 0.618 and the 0.778, if you want to get granular with it, this is your golden pocket. And that's why I have my golden lines here. And then the green is just equilibrium, right? Or just, sorry, the middle point right between these two. So this is my sell zone. If I'm short biased because I see this big move, I missed it. You know, such is life. You can't catch everything. And more importantly, you don't need to. You can just catch the high probability stuff. So we get the big surge down. Then we wait for the retracement into our golden pocket and we take the short. You can also wait for confirmation through the 50 of the initial range. So see this initial range here that we broke? It comes back up and it tests the equilibrium. And as you can see, there is definitely sellers responding to these fibs. Like the more you look at this, the more you'll see like, oh, it's very precise technicals here. So that could be another way to inform your bias. And then you can just catch the straight shot move, right? And I did not catch this leg, but it did keep me safe because I saw what was happening up here. I sure wish I slammed shorts, but you know, we all live and learn. So great question, and sorry for the super long answer. Letting my cat in the window, and then we'll keep on going here. I think we got about probably 10, 15 more minutes. So I'll get through as many questions as I can. All right, major delays. Do you use terminology of golden nugget? Well, good timing. I think that golden nugget is pretty close to the golden pocket or golden zone. I'm not actually familiar with that term, so that might be a separate thing. I think maybe it's a setup involving the golden pocket, but I'll look more into that. But I have a feeling we're talking about the same thing here. This golden pocket of basically where you can look for retracements of the zone before continuations through the range. All righty. Robert asking if there is a fair value gap indicator. Yes, there is. It's part of that Lux algo. Let's see, Lux algo. They have an ICT concepts by Lux algo, and that'll give you fair value gaps. Can I add it to my chart here? Is it showing? I don't see it. All right. I think I have too many indicators or something, but yeah, I use that one. It's good. He's a good programmer. Yeah, good stuff. All right, our boy VSync. How does this speak to low liquidity times or transitions after the close, for example, like hood tonight? Well, I would just say the moves are crazy and they're unreliable, and there's a lot of frothiness because market makers can whip it around more. And to me, that's just asking to get chopped up. So I don't touch the stuff. If I'm in something and I get a nice move overnight on hood, I'll often take profit, and just say, hey, I bet you this retraces a little bit by open. Because what you'll see so often is it might surge overnight or dump overnight, but then by 5 o'clock, when those algos start firing, it's right back to where it closed at. You'll see that a ton. Yeah, you whip your price back and forth. Exactly. Exactly. All right. We got WZTR, shorted NVIDIA in pre-market. Ended up doing, let's see, that's a big number. 1,240 trades, got stopped out at exactly 12 hours later. Oh, okay. I see what you're saying. So maybe some auspicious, oh man. Yeah, paper trading those, but it still hurts. It still feels real, right? So everybody's like, don't paper trade. It's not the same. To some extent, yeah, but I do think that it's just such a good thing to keep your skill set sharp and to learn new ideas, to get in the arena, try things. So sorry to hear about your trade there, but glad you're grinding. All right. On the chart, when you mentioned, Stuart saying, on the chart, when you mentioned before that you sold, did you use the trend line as well as the fib lines to also give an idea of where it was going? Let's see. Let me see if I can get what you're saying. Trying to remember what chart this was. Let's see. About 3 minutes. Okay, same chart. What did I do? Did you use the trend line? This trend line right here, this is probably drawn retroactively. I think that's a daily. Yeah, that's a daily trend line that I drew like last week. So no, I didn't use that one. Let's go back to the hourly. At the top up here, there we are. So I'm a big fib trader and I'm a big horizontal level trader. So I'm not so big on these downtrend lines, uptrend lines. I will use confluence between. So for example, we failed the 50 fib here, which is what I was looking for, right? We also were showing weakness, showing sellers stepping in when we were trading into that golden pocket. So just barely into the golden pocket over the 618 fib, and an instant sellers started stepping in on the hourly. 3 top wicks in a row, couple before open. So for me, it was pretty clear that this was a sell. And then you can confirm that when you knife through these moving averages on high volume. So lots of reasons why you could be, you can build your confluence through these types of things. You don't have to, the ICT, the guy himself is always so dogmatic. He's like, you don't need indicators. What good are indicators? The secret of the algorithm. It's like, okay, yeah. I still like my lines, so it's an art, like I was saying. So I hope that answers your question. And if not, let me know. All righty. I'm going to try to catch up on any that I might have missed here. Let's see. Is this trade the pool swing or scalping? So I scalp in one account, and there's also a swing account. So you can get a different product that fits your trading style. That's what I really like about these guys over a lot of other prop firms, which I've used a good amount. And of course, full disclosure, I'm on their stream. They're paying me, but I took the job because I like the product. So it's a good fit. It's a good fit there. So yeah, go to their website, check out what they have to offer. Pretty good values, I think. It's very fair pricing, and I know the people who confirm that, like who handle the payouts. It's like they're not pulling anything shady. They're paying people money. They're lenient. They have rules, and you should listen to them. But they're not monsters. They're good people, and I think it's really important to trust any company or to at least try to trust any company that you're giving your money to, especially in a trading world where the goal is you get good and then you start pulling out money from this, right? So yeah, good stuff there. Thanks so much for breaking it down. You're very welcome, Callie. Thanks for being here. Do you think Trade the Pool will add options in the future? I really hope so. I do too. I definitely don't know. I haven't heard anything about that. It would be fun. What I will say is that they give you great leverage on shares, and shares are so much easier to control. So you can maybe do a little bit bigger positions in some leveraged ETFs. So instead of buying Tesla options, you could buy a bunch of Tesla long or Tesla Q if you're a bear. So that's some kind of way, because options are just leverage, right? They're just big leverage. So you're kind of already getting options, right? Because you're putting in a small amount for the account and then you're getting access to all these shares. So you'll be really surprised. Coming from, you know, an options trading background, trading shares in size, it was so comfortable because it's like, oh, I'm still getting the big juicy profits that I'm looking for, but I'm able to control my risk so much more granularly. You know, I because with an options chart, you can't really trade the levels on it as much because they decay. So everything is constantly changing and you have to adapt with the Greeks. And with stocks, it's just is what it is, you know? Price memory is very accurate and it's good stuff there. So let's see. What Cheeky Peaky says, why do you switch from NQ to ES when volatile? Both are indices, right? Yeah, they're absolutely linked together, but it's just about the contract size. So where I might have a $25 stop on an ES position, I would need like a $50 stop or something for NQ because it's just, and these are the micro contracts, not a mini. I'm too scared to trade minis. I've been there and it's stressful. So you know, on the smaller contracts, there's still a much bigger swings and fluctuations of your profit and loss on NQ than there is on ES. So that's why. Okay, let me see if I missed any here. We got Tesla Trader from Morocco. Welcome. All right, we are waiting for the robo-taxi and the big dump before the third star gets formed. As you can see in my profile picture, it's a tiny picture for me, but I believe you. Meanwhile, you're in TEVA stock long. Is that a biotech or pharmaceutical? After I'll give you my biotech pick too. That looks pretty good. That looks pretty good. Okay, and we can see it populated now. This is the Luxalgo ICT concept. So see it drew my fair value gap right there. The VI is for a volume imbalance. It's very similar to a fair value gap. We have this line here, market structure. I forget what the other S stands for, but basically it broke that. So that's displacement of this range. So yeah, it's a really good indicator. And then you'll see these order blocks as well. Or I'm sorry, liquidity pools, right? So we can zoom in here and see it framed it for us. These top wicks show that there are sellers hanging out here. These bottom wicks show there are buyers. So price came up, came down, came up. Where does it get denied? Right in this liquidity zone. Told you I wasn't cherry picking answers. This stuff just works. Same thing here. We have buy side liquidity right here. When it wicked up and rejected, that's a bearish order block there. Price drove down to sweep these relative equal lows in this sell side liquidity pool. And you know, after grinding down, looks like it did hold. We can manually draw this here. There's our order block. There's the reclaim. See, look at that. Boom, boom, boom. Just responding to that. And we're drawing that because we're drawing it here because this is where there's kind of consolidation and it's kind of like a neckline forming. Depending on the time frame, you can, you can tweak it a little bit, but yeah, this stuff's so clean, right? It just works and it's repeatable and it's very, very mechanical. All right. Thank you. I appreciate that. Thanks for being here. All right. Stuart, what you're saying. You mentioned about ideas for a future video. It would be great if you could show us going through a checklist, e.g. the things you're looking to look out for before, during, and selling a trade. That's a great idea. I'm going to add that to my list and I will give you a ping personally if I fire that off because I think that's a good idea for sure. All righty. We've been going for at least an hour here. Good stuff. It flies with you guys. I swear this is fun. If anybody has any final questions, feel free to drop them and I can get to probably one or two more, but otherwise I'm going to get some water. I'm thirsty. Last call at the bar. Let's see. Is this your regular haunt channel? Okay. Good question. So I hang out. I don't always hang out in the Discord. I try to, I'm responding to pings and all of that. I am in stream every Tuesday on Trade the Pool. You can also find me in my Discord server, and that's linked in my the header of my Twitter handle, which is Justy Trades, JUSTY Trades. And you can see it's showed on screen there. Yeah, so feel free. Everybody's more than welcome to come on in, join my community. It's a free server. I do sell a newsletter, but I don't hawk it too much, except for right now. I'm all about building a really, really cohesive community of guys that I like, who are good traders and want to learn. So if you fill any of those boxes, you're more than welcome to come on in. And we got great people there, and it's a fun time. So that's where you can find me always. On Tuesdays, you can find me on Trade the Pool. On Thursdays, you can find me here doing webinars, and also on Trader TV 15 minutes after the bell. So that's my pitch there. Thanks for bearing with me. And I think it's probably about time to wrap this up. So after this, I will be hanging out in the Discord room for, call it 15 minutes. If there's people there, we can talk, chat about whatever you want, get some one-on-one time. And yeah, it'll be fun. So come on into our server, which is Trade the Pool. Tim, if you happen to have a link for that, that would be awesome. Not sure if I have access to share one. But yeah, thank you guys. Thank you, Stuart. I appreciate you, man. It's been 3 weeks in a row. That means a lot. And there's the Discord link. Perfect. My man, Tim. All right. Thank you, Tim. Thank you, everybody, for joining. We're going to be back next week. I'll give you a little cat to leave on here. This is Cleo, and she says bye too. And I hope you all have a great day. Cheers.